Welcome to Section 9, the final content section of the ASC 225 Income Statement Training for PNJ Group. In this section, we bring together three essential topics: how IFRS and US GAAP differ on income statement presentation, the internal controls your team must operate at every period close, and the 19-item checklist that keeps your period-end process complete and defensible. Let's get started. By the end of this section, you will be able to compare how IAS 1 and ASC 220 handle income statement presentation and OCI classification. You will understand the responsibilities of each role in the close process and know which controls target the highest risk areas of the income statement. Most practically, you will be able to work through the 19-item period-end checklist and know exactly what you are certifying at each step. Both US GAAP and IFRS require a primary earnings statement, but the naming conventions differ. Under ASC 220 and 225, companies may call the statement an income statement, statement of operations, or statement of earnings. All three are acceptable. Under IAS 1.81, IFRS prescribes the title statement of profit or loss, or statement of profit or loss, and other comprehensive income for the combined version. Neither framework mandates a rigid line item format, but US GAAP requires an operating income subtotal on the face, while IFRS requires certain minimum line items enumerated in IAS 1.82. Here is where the two frameworks diverge in ways that matter for financial statement preparation. US GAAP classifies expenses predominantly by function: cost of goods sold, selling, general, and administrative. IFRS allows classification by function or by nature, but when function is used, IAS 1.104 requires supplemental disclosure of expenses by nature, including depreciation, employee benefits, and raw materials costs. US GAAP has no equivalent mandatory nature of expense disclosure. On extraordinary items, both frameworks agree they are prohibited. ASU 2015-01 eliminated them from US GAAP in 2015, and IFRS never permitted them. Discontinued operations and EPS rules are broadly similar, but have scope differences worth tracking on conversions. The most technically demanding IFRS versus US GAAP difference involves OCI classification. Under IAS 1, OCI items are divided into two groups: those that will eventually be reclassified into profit or loss, such as cumulative translation adjustments and cash flow hedge gains, and those that will not, such as revaluation surplus and actuarial gains under IAS 19. These two groups must be presented separately on the face. The pension actuarial difference is critical. Under IFRS, an entity may elect to recognize actuarial gains and losses permanently in OCI, never recycling them to net income. Under ASC 715, those amounts must eventually be amortized out of a OCI into net income. And if a client uses the IFRS revaluation model for PP and E under IAS 16, revaluation gains accumulate in OCI, a category that simply does not exist under US GAAP. When advising on an IFRS to US GAAP conversion, three adjustments always require attention. First, eliminate any revaluation surplus sitting in OCI. US GAAP does not permit the upward revaluation of PP and E or intangibles, so that balance must be unwound. Second, reclassify pension actuarial amounts. What was a permanent OCI item under IAS 19 becomes an amortizable AOCI balance under ASC 715, with amortization phased into net income over time. Third, revisit the scope of discontinued operations. ASC 205-20 applies a strategic shift criterion that may be narrower than IFRS 5. A disposal that qualifies under IFRS 5 may not qualify under US GAAP, changing how those results are presented on the face of the income statement. Effective internal control starts with clear role boundaries. The team member performs initial preparation, data entry, and application of handbook rules at every period close. When a situation is borderline, unusual, or not clearly covered, the team member escalates. The team member never makes a final call on a material accounting judgment alone. The team lead reviews all team member work before it leaves the team and resolves borderline situations. When an item is material, unusual, or involves significant estimation uncertainty, the team lead escalates to the manager. The manager provides final sign-off on all material accounting conclusions and is responsible for overall quality control. The income statement carries specific control risks, and each one has a targeted control. Revenue cutoff testing focuses on the last 5 days of each quarter and the first 5 days of the following quarter, the window where timing errors are most likely. Gross margin is reviewed by product and segment, with any variance beyond 3 percentage points triggering documented investigation compared to prior periods and budget. All non-operating items are reviewed by the team lead, and any item above $50,000 requires documented support. The discontinued operations assessment happens at every period end, with the conclusion documented even when the answer is that nothing qualifies. EPS calculations are verified through an independent team lead recalculation, with dilutive securities confirmed against both the cap table and debt agreements. 3 controls address the more complex income statement areas. The AOCI roll forward by component must be prepared each period and reconciled to the balance sheet balance. This is how you confirm that reclassification adjustments match what was actually recycled to net income. Intraperiod tax allocation requires manager review in any period that includes discontinued operations, OCI items, or equity method investments. These are the periods where the tax allocation is most complex and consequential. Finally, comparative period consistency is not optional. Any reclassification of prior period amounts requires retrospective restatement and note disclosure. These controls work together to keep the income statement internally consistent across periods. The 19-item period-end checklist is the operational summary of everything covered in this course. Items 1 through 5 address revenue, cutoff testing, gross versus net analysis, COGS completeness including LCNRV write-downs, gross margin variance review at the 3 percentage point threshold, and operating expense classification consistency. Items 6 through 10 cover income statement structure, operating income display on the face, non-operating item review, discontinued operations assessment, and confirmation that extraordinary items have not been used. Items 11 through 13 address tax and OCI, intraperiod tax allocation, a OCI roll forward, and OCI net of tax presentation with reclassifications. Items 14 through 16 cover EPS. Items 17 through 19 are sign-off, disclosures reviewed, team lead approval, and manager sign-off on the 3 highest risk areas. Let's lock in the key takeaways from this section. IFRS and US GAAP share the same goal, transparent income reporting, but diverge meaningfully on OCI recycling rules, the revaluation of long-lived assets, and required nature of expense disclosures. The pension actuarial difference is the one most likely to create a conversion adjustment. Permanent OCI under IAS 19 becomes amortizable OCI under ASC 715. On conversions, always address revaluation surplus elimination and retest the discontinued operations scope under the ASC 200-520 strategic shift criterion. Role clarity is a control in itself. Team members escalate, team leads review, and managers sign off, and none of those steps can be skipped. The 19-item period-end checklist is not a suggestion. It is the documented evidence that your income statement is complete, accurate, and consistent. Thank you for completing this section on IFRS versus US GAAP, controls, and the period-end checklist.